Start your day with It's the Business. Here's Phil Dobbie.
Today, bond yields have been rising in the US over recent weeks, and investors are moving to other asset classes like to the share market, pushing share prices ever higher. But Paul Kavanagh from Patronus Partners sees nothing wrong with that. It's all good, he says.
At the moment, I feel comfortable with the way that the financial market's positioned. It's allowing entrepreneurial risk-taking to take place as we speak.
But meanwhile, what about the massive debt that governments are building up? And even if it's manageable in the West, what about those developing nations, particularly those reliant on the US dollar? How will they weather the storm if they owe a heap of money in a foreign currency?
There will be more of a requirement this time around on the US to look at some of those that are outside of their sphere and look at routes to assist.
So they've got to help out, in other words, but will they? The same goes for the rollout of the vaccine, of course. We need to help other countries. Otherwise, the virus will just keep on developing and mutating. So isn't it time we looked seriously outside our own boundaries and took a more global view on how we spend government money, the aid we give to fallen economies, and how we speed up the global vaccine rollout? It's Wednesday, the 7th of April, 2021. Good morning.
And now, it's the business, making sense of it all with Phil Dobbie.
Now, if you listen to what reserve banks around the world are saying when they give their policy announcements, I understand many of you probably couldn't give a damn about what reserve banks say when they give their policy announcements, but they are all saying pretty much the same thing. So you only have to listen to one of them because they're all saying the same thing. The RBA in Australia yesterday was the latest one, saying, basically all the signs of economic recovery are there. They're all very strong. The economy is going gangbusters. We're going to be back where we were before we know where we are. But we're going to keep interest rates low for years to come, just in case, and we're going to keep buying bonds from the government. Whatever we can that the government issues, we'll be grabbing hold of it. Every central bank is saying that. That is despite, in Australia's case, the economy bouncing back. They haven't had a single COVID case over the long weekend. Not anyone dying from it. Also, no one contracting it. It is just as though it's not there. The unemployment rate there has fallen to 5.8%, which is close to where it was 4 years ago without a pandemic. House prices are rising. I mean, life is back to normal when Australian house prices continue to skyrocket. There are no dark clouds apart from housing unaffordability back there. But look, the central bank is saying interest rates won't go up for 4 years. And they can't put them up anyway, however good things are in Australia, because other central banks are busy telling everyone how they're going to keep their interest rates down. Basically, it's a game between all the central banks. They're all colluding over this. And the Fed in the United States, the Federal Reserve, is saying the same thing. They are the ringmaster behind all of this. The minutes of their last meeting is out today. And it will no doubt talk about how well the economy is going. Things are looking marvellous, but we must still keep interest rates low for years, and we must keep buying up government bonds. Because there's this big supply of bonds. And if there's an oversupply of bonds, then prices will go down, yields go up, which will make refinancing government debt, of which there is rather a lot, that much more costly. So we're going to talk about this balancing act between funding government debt whilst also ensuring that bond yields don't rise, pushing interest rates up. We're going to talk about that with Paul Kavanagh from Patronus Partners today on the podcast. Meanwhile, Matt Hancock has been addressing the nation again from his downstairs toilet.
The vaccine programme continues apace, and today we've reached the milestone of 3 in every 5 adults in the UK who've been jabbed. This is incredibly good news, as well as almost 5.5 million people now who've had the second jab.
It is startlingly good news, isn't it, that Britain at long last is leading at something through this whole COVID crisis, whereas there are places that haven't been jabbed anywhere near as much, and they're seeing another wave. So Justin Trudeau yesterday declaring Canada is facing a very serious third wave. They're getting up to their post-Christmas peak. In terms of the number of infection numbers, just 15% of the population has been vaccinated there, so they could take an economic hit from all of that. Whereas we're doing okay. Australia is doing okay. New Zealand is doing okay. They've opened a travel bubble, actually, between Australia and New Zealand, so Aussies can go on holiday to New Zealand and vice versa. That's all they need, just a change of scene. they'll probably decide after that they don't need the rest of the world. They're happy just at the end of the world. They're just going backwards and forwards between their two countries, which should be one country anyway, really. I'm sorry for any New Zealanders listening, but just join up with Australia. Then you don't need to worry about travel bubbles because you're all part of the one country. Just as like we can go between Wales and Scotland, well, supposedly, and maybe we'll make do with that because we might not be going anywhere else because everywhere else is waiting to get their vaccines. We'll have had the jabs. We're desperate for our summer holiday and we can go to Wales, Scotland, where else? Northern Ireland, perhaps, maybe the Isle of Man. Or Jersey. If you are looking for somewhere more exotic, go to Jersey. Supposedly, we can go anywhere from May, but not if they haven't been vaccinated. This is Boris yesterday.
I do want to see international travel start up again. We have to be realistic. A lot of the destinations that we want to go to at the moment are suffering a new wave of the illness of COVID, as we know. It's not going to, we can't do it immediately, but that doesn't mean that we've given up on May the 17th. We'll be saying as much as we can, as soon as we can, about international travel. I know how impatient people are to book their holidays if they possibly can. But I think we just have to be prudent at this stage.
So this is the issue, isn't it? I mean, Europe is very slow on the vaccine rollout and on the take-up of it. Lots of people don't want it. We might have a vaccine passport, but what happens if every country you want to go to is a no-go red zone? You won't be going anywhere, even though, bizarrely, this is hard to believe, but it was in The Independent and a few other newspapers yesterday, 8,000 tourists are coming into Britain every day. This is according to numbers from the Border Force. A traveller gave the reason for coming was to visit Big Ben, according to The Independent yesterday. So, I don't know, perhaps Border Force thought Big Ben was a relative, a very well-endowed relative, or just a very large man, generally. So you can understand why people are getting a bit upset about this. I mean, we have to pay a £5,000 fine if we leave the country on holiday, but people are coming in from areas where the infection rate is higher, which is just about everywhere now. 8,000 a day who are tourists. We've actually got 20,000 people a day coming into the country. 8,000 of them, the Border Force says, are tourists, which is shocking, isn't it? This from the country that wanted to take back control of its borders and its immigration.
We can take back control of our immigration system.
Well, clearly not. I tell you, it must be very annoying, mustn't it, for Boris Johnson that this thing called the internet keeps his old speeches. He must wish that the internet was a bit like Snapchat, where, you post something, it disappears moments later, so there's no history, so you can get away with whatever you want. But look, faster vaccine rollouts and extra cash injections by governments that can afford to do it, or can afford to build up the debt to do it. They've all added to the International Monetary Fund forecasts that were revised yesterday. It's only a few months since they last did their revision. Now they've done another one as well. They've come out with a whole new set of numbers, now even better than before. So they've upped their forecast for the globe from 5.5% in January to 6% now. Globally, of course, it is much better in rich countries than poor countries. That's the way it works. In fact, I'd like to look at poor countries a little later on today, and also perhaps in another episode, because how do they come out of this? So they've increased next year's a little as well in their forecast globally. The UK is going to grow from 5.3% to 5.3%, I should say, up from a forecast of 4.5% that they made in January. Mind you, of course, that is a good growth rate, isn't it? 5.3%. But we have to bear in mind, we did fall almost 10% last year. So we've got a lot of ground to make up. But the biggest leap has been in the United States. Their forecast from October last year, I think it was, 3.1% is what the IMF were forecasting. Now they've taken that up to 5.1%. And they say that doesn't include the impact of the infrastructure stimulus plan, which is going to kick in, but it's going to last for several years. But it would have some impact this year. So economies are bouncing back, but central banks are saying, no, we're going to hold back on interest rates. And we're going to keep on issuing purchases of government bonds, even though economic growth is increasing. Jobs are coming back. We're going to pretend none of this is happening. And they're just going to close our eyes, block our ears and go, no. It's not good. even though it clearly is. And it's all because central banks are paranoid about bond yields. So are bond yields actually the central force driving economies right now, determined by the price of bonds? If they fall too much because investors go elsewhere, or the market is flooded with too many bonds because the government is issuing too much debt, all of those things could push yields up. So they try and contain them by these supposedly independent central banks buying up loads of these bonds. And they have to keep doing that because who else is going to hang on to them, particularly if the future is looking brighter? So let's look at how bond yields and the role of central banks are driving the markets right now. Forget about the idea of free markets. Paul Kavanagh is the CEO of Patronus Partners. So, Paul, the yield on 10-year treasuries. Let's look at this first of all. US government bonds, 10-year treasuries. They started the year at less than 0.9%. They're now up around 1.7%. But even at that rate, I mean, nobody is making any money out of that because inflation is potentially higher than that. So when we think that the future is looking brighter, hardly any surprise that people get out of bonds and look at equities. And that's why we've seen the various share indices all rising, reaching new highs over the last few days. I mean, you'd be nuts not to buy into them, wouldn't you?
Yeah, I mean, listen, I think we're at a fascinating junction of financial markets at the moment. And you know, you asked the question, you know, are bonds driving everything at the moment? And to some extent, yes, they are. We can take good cheer from what the central banks, who are not in an enviable position anywhere in the world at the moment, have done in order to try and protect and preserve as much of the economy as can be made through this pandemic. And the recent data that we're seeing out from the US at the moment, including jobs,
all good. Yeah, manufacturing numbers, jobs coming back, people are being vaccinated. I mean, that all of that obviously means that people are prepared to take more of a risk. So another reason to move away from bonds and start saying, yeah, well, let's put money into equities, let's invest in growth.
Yeah, and you know, we can live with it. And really, the job now is really to establish a sort of range, establish a sort of where are we comfortable with yields being, where yields operating at the moment, which is not upsetting the equity markets, is not upsetting the economy and not putting the brakes on the economy. And this is where we're coming to. I mean, we don't have a definitive answer at the moment. One senses that it's going to be a step-by-step process of careful management, and no one wants to reveal their cards too early. So the official statements, look behind the headlines, see the actions, and it's really the actions that are going on that is what one should be looking at. So if you look into Europe and you look at what is happening there, yes, we're not yield controlling, we're not controlling the yield curve, but at the same time, the balance sheet is growing quickly. And so it comes, you know, it's a point that we made in our notes. If it looks like a duck, you know, it is a duck.
But if people are investing in riskier assets, that means they are by nature bailing out of bonds, which means that we are going to see those yields rising. And so and of course, central banks don't want to see that happen. They want to see them low. So does that mean they are forever just going to have to buy out more? The more people get out of it, the more the central bank has to step in?
Well, we believe that there's a sense of inevitability to all of this, but it's how far can the central banks delay that? As I said, you know, they're not in an enviable position, but this was pre-pandemic. They were not in an enviable position.
I mean, they were absolutely quantitative easing was still very much a thing, wasn't it? Even before we got.
And so we have this scenario, and obviously. And there's always this phrase when if you want to make God laugh, tell him your plans. And the same could be true when you hear on fiscal policy how taxation and rising tax levels are going to resolve our problems with debt. They're not.
No way. Yeah.
So you've got to be able to sort of come out and say that this will need paying back. We will need to start to balance our books, but it's not a votable mandate. to be coming out and saying that you're going to you're going to try and balance the books at the moment, because you're just compelling an economy to sort of crash. I've always used the phrase, it's like dabbing the brakes and hitting your head on the windscreen. It's that type of scenario with all of this.
Well, it's pulling money out of the economy, isn't it? I mean, if we look at the simple argument that modern monetary theorists use, if the government is creating money, or the central bank argue as to whether it's the government or the central bank that's creating this extra cash, but if they're creating it, that's extra money which is finding its way into the from the public sector into the private sector. If you tax, obviously you're pulling money out of the private sector and sticking it back in the public sector, and actually it disappears.
Yes.
So you're shrinking the money supply. Exactly the wrong thing to do right now.
Yeah, absolutely. And so there's an argument to be made at the moment, which I think the market is arguing this case, that we are into a relative sweet spot within the economy at the moment, that the central banks are allowing balance sheets to grow. It's not causing too much hardship to risk assets, risk appetites, and the like. And as a result of that, it's giving the market time to breathe and build its confidence to come out of this pandemic period.
But is it actually isn't it doing the opposite of that? I mean, you look at share prices in the United States, you look at house prices around the world, and you see inflation in house prices, you see inflation in asset prices, you see cryptocurrencies doing weird and spectacular things. And you have to think, well, how much of that is because people, not putting money into bonds, they're just looking for anywhere that's going to deliver them some sort of yield, and isn't that dangerous?
Well, I mean, I think what we're looking at here is by design. It is we want the world to move up the risk curve. We need people to take more risks. We need people to be entrepreneurial and to move out there. Because if you do get roaring stock markets, I mean, yourself in the US. It's the savings plans, which are all equity based, create that feel-good factor for Middle America, and so that's been incredibly beneficial in terms of building confidence in terms of the consumption of items. So confidence is high. Anecdotally, I mean, I won't say that I've got a survey as vast as the Bank of England, but certainly in a community I'm looking at, business is picking up. March was a very good period. Car sales in March 2020 looked like being 2021 looked like being higher than they were this time last year. So confidence is definitely building, and this is something which must be giving the central banks some confidence that all of the work, all of the heavy lifting that they have done is now starting to yielding a result. And that's not to dismiss the hardship that's been faced over the last 12 months. But everybody's going to have the best chance of coming out cleanly with a functioning and entrepreneurial economy if that confidence can build from this sort of base.
But how do, because the government in the US, of course, is putting more and more money in. So after, this check that's gone into everyone's bank account and the money that's being rolled out to invest in the recovery, then we're going to have, 2 trillion. Sorry, it's so easy to get confused, isn't it? Being invested in the recovery program. And then there's another 1 trillion coming after that. So all this extra money which is being invested obviously adds to the government debt. That means more bonds that need to be bought, which means, the central bank is going to have to step in and buy a chunk of that. So even though the economy is recovering, if they want to keep those bond yields down, if they don't want to see interest rates or inflation kicking in, they're going to need to buy more and more of this. So that's going to be problematic, isn't it?
Well, it's the question mark, and it comes back to the start, is at what level is it problematic? Are we at a level at the moment where it's proven to be problematic? When you can see that the US stock market has just printed a new high. And the stock market is rotating. There's no question that rising yields do damage to high growth stocks, long-term growth stocks, discounting back to today. And so we have seen that element of rotation. It's the reason why Apple stock is in negative territory for this year. It's the reason why companies such as the oil businesses are up 20 or 30%. There's that rotation that is taking place within equity markets at the moment, and certainly taking some indexes to the new high. But there's certainly not a whilst we get wobbles and bouts of nervousness, they're soon overcome. So the question is, yes, we know the backdrop is issuance of bonds running faster than central banks are increasing their balance sheets. We know yields are rising. I suspect when we're back here, looking at this in a week, 2 weeks, 3 weeks time, we're testing new highs on yields again. But we're not seemingly at a level at the moment that is making anyone that uncomfortable.
So what is the problem if we do see yields go? Because obviously yields are way lower than they were before the pandemic hit. So what is the problem if we start to see yields rising up to pre-pandemic levels?
Well, so really, we've obviously increased the debt profile of right across the board from private to business. There's a huge amount of increase in debt, but mostly felt within the public sector. And of course, a lot of the debt that has been taken on board, particularly here in the UK, has become very much reliant upon what I'd refer to as short-term debt. Laying out long-term plans you can't do with the central bank, but you can do with the private sector. As the private sector has pulled back from that, then more of our debt book is shorter term and needs rotation. And it is very material that if you ask the Chancellor in the UK to find another 30 billion each year, that he's got to scratch around in some very uncomfortable places to find an additional 30 billion. But that could be wiped out in a heartbeat on the refinancing of large parts of a $2 trillion sterling debt book. And that's your problem, is that you can never get on top of the problem fast enough. And you certainly, we've argued it before, but repeating, I think we're way past the point where the tax base of this country is capable of financing.
So your point is, if if yields go up too much when they come to refinance, it's going to cost the government more to. And
it's more. It's the proportion of effectively your GDP being consumed by just paying back the interest and not being put back into the economy where it needs to be working. Of course, you can keep increasing the book, and this comes back to there will be a point at some point where it's going to, we're creating growing balance sheets at an exponential rate, which will bring a whole different set of repercussions in the fullness of time.
Well, here's a radical thought. Why does the money all have to go through the issuance of bonds, which are then offered on the open market and then bought back by central banks? Why can't a proportion of them, given that we are in extreme intervention mode right now, and the idea that all of this is a free market and there's independence between central banks and the Treasury, given we're in that world now, the radical thought is, well, maybe actually all of that debt isn't issued as bonds. Maybe some of that debt sits as an overdraft in the Bank of England for the Treasury, and then you control how many bonds you want to issue to the market, given that you're manipulating the market anyway.
Well, then you're opening a door into the next phase, and everybody.
Do you think that could happen?
Yeah, absolutely. I think that there will inevitably come a point, because you've got to think about, we are talking about ensuing carnage in financial markets as if it's a given. And the reality is, to avoid that carnage, you've obviously got to enable a number of things to happen. And one of them, which is the principal method of rebalancing your books, we all have memories. I say when we tried to do this post the 1970s, early 80s period under Margaret Thatcher, And just seeing the images of what took place at that time, the suffering and destruction to the economy in order to get the books back in, we know what that looks like. And so do central banks, and they do know that is not an enviable position, and one that they want to look at. It's like looking over the precipice and just putting back and saying, okay, we don't want to do that again. So what are our other options? And so those other options, you start to think about, debt management and reneging on debts, things like that, which again, it's not something that any developed economy, particularly UK out there, would want to be going down that particular route. Nor can I stress that we need to be talking about this at this stage. But we're slightly into uncharted territory. The debt book that we have, whilst comparable to other developed economies around the world, doesn't look too bad. We're all heading in a direction at the moment, and Japan has obviously gone a long way in this direction at the moment without seemingly too many difficulties. We can discuss the economy, but of course we could be going and we could be sitting here for many years to come, still mulling over this issue. And in the meantime, entrepreneurial people have got on and built their businesses and made money in an environment where there are plenty of trends that are being developed as a result of this largest
all because we've driven up this huge amount of public sector debt that's enabled the economy to get back on its feet, which is all good. So the question is, what do we do next to try and get rid of that debt? Which we'll address that problem, but what about those countries that don't have that flexibility? So developing nations which don't have such a solid currency, that perhaps they're reliant on the US dollar, for example. European nations tied to the euro, which the European Central Bank can buy up bonds, but it's a very slow and political process. What happens to those countries in this very interventionist world that we live in now? I mean, they are going to be the poor cousins, aren't they?
Yes, they are, and actually, it's going to be an interesting dilemma, particularly for the US, that over the last few decades has built stronger relationships with the demand cycle, and also outsourcing manufacturing to these type of economies, and allowing debts to be issued in dollars. There is going to be this need for dollars in those areas. So these are not economies that can quite simply be walked away from and ignored, because, and again, the analogy one does sort of bring to the table, and I've seen, you've seen the picture of the 7 individuals climbing the rocks, and they all have to work together to get to the top of the surface. And once one is not properly positioned in, it's putting weight down on the other 6, and there comes a point where it brings the whole thing down. Again, I think that we've been through enough cycles in the recent past to know that these things don't end particularly well and have ramifications, and therefore action needs to be taken earlier. So I think that there will be a more of a requirement this time around on the US to look at those that are outside of their sphere and look at routes to assist.
Yeah, certainly wouldn't have happened under the last president, would it? We would have been in a very tricky situation, I think, if that was the situation. So, look, you're talking about us being in a sweet spot. Just to finish off for today, then. So, you think yields, on bonds in the US and around the world will slowly start to creep up, but not enormously to such a point that it's going to create an imbalance, and nothing wrong with this inflation in asset prices. You're saying it's a good thing because it's getting investment moving. It's
feeling like that sentiment is positive. It's at the moment I feel comfortable with the way that financial markets are positioned. It's allowing entrepreneurial risk taking to take place as we speak. Yes, I can see yields continuing to edge higher, not expecting any dramatic moves. So far so good.
All right. Well, let's hope you're right. Good stuff. Always great to get your take on these things, Paul. We'll catch up with you again soon. Thanks.
Thanks, George.
Now, tomorrow on the podcast, we're going to look at the future of the British steel industry. Should we just let it go? Let it go? Or that would mean, of course, buying in steel, imported steel probably from China, heavily polluting China. So do we buy it cheaper and ignore our social responsibility to try and save the planet? We'll look at that. Also, vaccine passports. We'll be visiting that topic on Friday, but looking at whether there are technological solutions, not just to that, but also guiding us out of the pandemic. We'll be looking at that. And then on Monday, when supposedly the shops open and restaurants and pubs and cafes as well, we'll look at how the hospitality sector is going to be coping with this reopening and whether, in fact, distancing rules are going to slow down the ability for those companies to start making a profit again. So that's all coming up over the next few days. Hey, looking at the newspapers today, the front page of the FT, Goldman bought £75 million of shares in Deliveroo to lift the price on debut. Well, it didn't work, did it? The underwriter stepped in to try and stop it all falling apart. It shows how much worse it could have been. The Metro, foreign hauls to cost a packet. The cost for COVID tests might prove just too high. If you have to take a COVID test, if your holiday destination falls into a red zone, it could cost £420 per person just for the COVID test. Actually, if it went into a red zone, then you'd have to isolate and then pay the £2,000 or whatever it is to stay in a hotel when you came back. Cheaper tests to save our summer holidays. That's the front page of the Daily Mail. Pretty much the same story. Most of the other ones, the other newspapers, are picking up on the fact that this trial for younger people taking the AstraZeneca vaccine has been halted over fears of blood clots. It's okay for, the old folks getting the blood clots. We don't want the young kids to get it. So there's obviously something in it, but it's a very small percentage. You're still better off, aren't you, taking your risk, because it's a much lesser risk than getting COVID. And then the virus linked to mental health problems. It's telling us all gaga. Yeah, I think so. We've all been locked in for long enough now. In fact, on that, the Daily Star's got a picture of Boris Johnson in a shower. And it says, well, it's worth a go. A cold shower fixes your brain. Brits are being used to try icy showers to try and clear the brain fog. And they say there's one person in particular they think should definitely try it out. With Boris there taking a cold. It is actually very good to have a cold shower. It does you the world of good. The Independent also, the child vaccine trial halted over blood clot concerns. And the front page on the Daily Telegraph as well. So pretty much the story on all of them. The Times saying the same thing as well. If they're not covering that, they're covering the holidays. Daily Express, PM, no need to deviate. We'll stick with the roadmap, he says. Well, that's it for today. That's another edition of It's the Business. Don't forget, if you're enjoying it, tell your friends about it. We'd like a few more listeners, just a few more listeners. Well, actually, we'd like a few thousand more listeners, but, we'll be patient. And so tell them you can find us at itsthe.business or wherever good podcasts are found. See you tomorrow morning. Have a great day.
It's the Business with Phil Dobbie. Listen online at itsthe.business or wherever good podcasts are found.